Stop what you're doing. If you own any AI stocks, you absolutely need to hear this 5 model valuation breakdown. Because while everyone is out there obsessing over high-flying chip designers like NVIDIA and AMD right now, they're completely ignoring a hitting bottleneck that could literally bring the entire AI revolution to a grinding halt. Think of the company we're looking at today, Cohu, as the ultimate pick-and-shovel play in this massive AI infrastructure gold rush. Last week, I ran Cohu's latest SEC filings and fundamental numbers through 5 distinct valuation models, plus Warren Buffett's and Peter Lynch's personal investment checklists. And honestly, what I found shocked me. Their total addressable market in AI compute just rocketed to an estimated $750 million, and their intrinsic value might be massively detached from current market prices. So let's dive right into this. Before we jump into those financial models and the raw data, just consider this bold question. While everyone is hyped about making incredibly complex AI chips, who actually ensures these ultra-expensive processors work before they hit the data center? If they fail, the costs are catastrophic. By the end of this explainer, you'll know exactly if Cohu is a Buffett-style value buy or a classic Peter Lynch value trap. Look, I know the notorious boom and bust cycle of the semiconductor industry is a massive pain point that terrifies retail investors. It's exactly why so many people lose money trying to time this sector. But today, we're cutting right through the noise. I'm going to give you a clear, actionable framework you can steal right now to evaluate this company's true worth. We're breaking down everything from their balance sheet fortress to Wall Street's exact upside targets. Here is our roadmap for today. We'll start with AI's hidden infrastructure engine, then look at navigating the semiconductor cycle, break down the Q1 2026 financial snapshot, cover upgrading the AI market opportunity, and finish up with Wall Street's strong buy consensus. Section 1. AI's hidden infrastructure engine. To really get why the financials look the way they do, we have to start with exactly what Cohu does behind the scenes of the tech industry. Straight from their 2026 proxy statement, their mission is crystal clear. They are the critical, behind-the-scenes infrastructure testing the world's most demanding semiconductors. Essentially, they are the quality control gatekeepers for the absolute most advanced chips powering our modern world. No test, no chip. So what do they actually sell to make this happen? Well, they don't just build the physical testing handlers that move the chips around the factory floor. They supply advanced inspection and metrology equipment, and crucially, software analytics. Their PACE prescriptive software actually uses continuous signal analysis to predict equipment issues and optimize manufacturing yields globally. It's like having a crystal ball for the manufacturing line. And as we'll see in a minute, this software strategy is completely transforming how they make money. Moving on to Section 2, navigating the semiconductor cycle. We definitely have to acknowledge the reality of the market here, that infamous boom and bust cycle. Cohu is certainly not immune to these massive macroeconomic swings. Looking closely at their SEC filings, the proxy statement bluntly notes that 2024 and 2025 saw an unprecedented industry downturn. During this bust, Cohu missed their growth and profitability targets. This wasn't just a tiny bump in the road. It was a real hit that severely impacted executive bonuses. In fact, it resulted in 0 annual cash incentives being earned by their CEO in 2024. Ouch. But let's look at how this builds over time. Contrasting that past slump with a gradual recovery, we see that 2025 finished with a very solid 13% year-over-year sales growth. And rolling right into the first quarter of 2026, things are really heating up. By the end of March, they achieved an estimated 78% test cell utilization rate. Now, that's a vital metric. It shows us that customer manufacturing demand is rebounding, and it's rebounding fast. Which brings us to Section 3, the Q1 2026 financial snapshot. The crucial question now is figuring out exactly where their balance sheet stands today as that utilization climbs. Their Q1 results show $125.1 million in net sales. Now, to be completely objective, they did post a GAAP net loss of $12.1 million for the quarter, though their non-GAAP income actually squeaked out a slightly positive $0.6 million. But listen, the absolute most important number to focus on here is their liquidity. They are sitting on a massive, absolute fortress of nearly $500 million in cash and investments, specifically $488.7 million. They are heavily capitalized to aggressively go after new market opportunities without breaking a sweat. And what's really fascinating here is the underlying shift in their business model. Roughly 60% of that Q1 revenue is now recurring. That's huge. This is driven by their software subscriptions like the PAIC analytics we talked about and ongoing services.
For a hardware company that is traditionally held hostage to cyclical boom or bust sales, building a 60% recurring revenue base is an incredible, bulletproof buffer against future industry downturns. It's a total game changer.
All right, Section 4, upgrading the AI market opportunity. This brings us to arguably the most exciting part of this entire explainer, the newly upgraded AI infrastructure supercycle. This is Cohu's biggest forward catalyst. Get this. In early April 2026, Cohu announced $30 million in follow-on orders for their Eclipse platform. And here is exactly why that matters. This specific platform is configured with active thermal control to test next-generation, high-performance computing processors. As processors get denser and way more powerful for AI, thermal constraints, basically the chips getting way too hot during testing, are a massive hurdle. Cohu is directly solving that exact problem. That early market momentum and those specific design wins led management to make a huge adjustment. They vastly increased their estimate for their AI-driven compute addressable market to a staggering $750 million. The pie they're eating from just got exponentially larger almost overnight. Plus, it's not just the compute processors. They recently bagged another $5 million in orders for their DiamondX platform to test next-generation gallium nitride, or GaN, power devices. These are the advanced power architectures directly destined for AI data centers. So Cohu isn't just testing the brains of the AI revolution, they're testing the massive power supply running it too. And as CEO Luis Miller pointed out, these design wins are materializing into real, tangible guidance. Because of this phenomenal traction, they are officially raising their full-year 2026 high-performance computing revenue outlook to somewhere between $80 and $100 million. That is real money hitting the books. Let's wrap it up with Section 5, Wall Street's strong buy consensus. We need to see how all of these massive catalysts translate into Wall Street's current valuation of the stock. Are the analysts actually pricing in this AI upgrade? Based on data from S&P Global covering 7 top analysts, the average price target sits at $57.43. Compared to recent trading levels, that represents a potential 15.3% upside. What's super compelling here is that even the most pessimistic target on the street, down at $50, still suggests the stock is currently holding its value. Meanwhile, the most optimistic target implies a massive 30.5% upside potential. The consensus sentiment across prominent firms like Needham, TD Cowen, and Jefferies is overwhelmingly positive. We are looking at a nearly unanimous strong buy with literally zero analysts telling you to hold or sell. None. Wall Street is clearly buying into this recurring revenue and AI testing narrative. Of course, we always have to look at the full picture. Independent analysis from platforms like Simply Wall Street reminds us of the core tension here. The bull case is totally clear, accelerating AI data center exposure and higher test cell utilization that's compounding quickly. The risk? Well, this relies heavily on a few very large, incredibly demanding customers. If those specific AI rollouts are delayed, or if that customer concentration turns into lost contracts, the growth story could absolutely stumble. So I'll leave you with this final thought to consider as you build out your own portfolio. As AI chips become infinitely more complex and increasingly power-hungry, is the critical infrastructure that tests them the market's absolute best-kept secret? You have the framework, you've seen the raw data, now it's up to you to decide. Keep learning, keep focusing, and I'll catch you in the next explainer.